Hi everyone, it's Tom Buck from the Calder Group here. Welcome back to the video, and we're back to talking about investments and investment performance. I'm pleased to say after a 3-month hiatus, he couldn't hide from me anymore. We have Alex from Blackfinch to run through the current situation. So hi Alex.
Hi Tom, how you doing?
I'm doing very well, sir. How about yourself?
Good, yeah, very well also. Thanks, very well indeed.
Excellent, excellent. I believe just holidaying in the UK at the moment and avoiding the perils of flight and rushing back and paying about 5 times the value for a plane ticket.
Yeah, that's right. Avoiding airports for now. So yeah, the staycation is the theme in this household for sure.
Absolutely, yes. Well, our daughter is now the proud owner of a tent and various tenting equipment, so she's doing the same. And
Yeah,
apparently, my little 3-man tent isn't suitable, but hey ho, there you go.
exactly.
Now, it's been a few months since we spoke, but obviously, I think we got to the point, certainly through COVID, we were talking quite regularly because everything was changing on a day-to-day basis. I think it's fair to say that we've seen things calming down a little bit. The market's a bit more sensible. I think if I can dive into a question based around that, because we have seen the stock market really, that 5.9 to 6.2 in the FTSE 100 range. It's been fairly placid, fairly quiet. Does this mean that the UK being in recession has no impact or has had no impact? And is it really as settled as the market seemed to indicate?
Yeah, so obviously, since we last spoke, we're now in the first technical recession since 2009. And as you quite rightly point out, the stock market doesn't seem to have reacted to that news as you might have initially thought. Now, the reason for that mainly is because it was blatantly obvious that a recession was coming. If you shut down, an entire country or countries across the world, you are going to put the economy into a recession. And of course, as we've highlighted previously on these chats, it's easy to get caught up in the media's obsession with doom and gloom. And of course, thankfully, the stock market actually looks away from that and actually kind of focuses more on the reality of the situation. So it was very expected to happen. It did happen, and that's where we are now. But of course, the hope is that we can exit from this recession fairly quickly. And of course, the actual risk to the markets over the sort of near term is just how long this will go on for. So factors such as unemployment will obviously affect how long we're in this sort of recessionary environment for and how businesses can cope with that. So that's actually what will likely affect the stock market going forward, not just the simple news that we are in a recession. I would also want to highlight to your clients as well that, of course, the fact the recessionary data that actually puts you into a technical recession is all backward looking. So, of course, what we try to do in our jobs, of course, is to look to the future and actually position the portfolios to benefit from that. And so it's very easy to, as I say, get caught up in the sort of what the media will sort of portray. But do bear in mind that data is backward looking. And we've already seen some signs of improvement in economic activity globally. That's the sort of more interesting points for us.
Yeah, absolutely. I think that's a fair comment, and certainly reading the news today, I think we've got the budget coming up in November, a couple of months' time, and already we're getting people positioning in terms of expecting tax hikes, and the pros and cons of doing that. So again, it's now what decisions we make in the coming months that we'll see whether the markets react, I suppose.
Yeah, absolutely. So as is definitely the theme, has been since sort of March really, is that central bank and government response to the damage to the economy that will ultimately be the sort of foundation of where markets go. And that's absolutely what we're focused on.
Okay, you may notice we're getting a bit of a commentary from the back in the dog here. I'm working from home today, and he's in full agreement that the recession is nothing to worry about. I'll just quickly point that out. One thing that I suppose has a bigger impact, and we're seeing it in the news pretty much every day, is we are getting that closer to the US presidential election. It's moving away from the economy fight we were expecting, because obviously Trump can't fight on the economy at the moment with what's happened. The opinion polls are showing that Biden is well ahead, although I think I read a report today that that's starting to narrow with the law and order debate going on. But are we sort of built, or the market's building in an expected Biden and Democrat victory? And based on the fact that we were doing that in 2016 when Trump came in, is there a position that you can put investments to take into account the fact that Trump could actually surprise us all again and remain in power for another 4 years, and the economic and the political fallout that will come from that?
Yeah, I think you're absolutely right to point out now that the US market particularly is paying more attention to the presidential election, because up until this point, and understandably so, it has all just been COVID focused. But I now think that we're starting to see the markets pay more attention to the upcoming election. So I think if we did get a Biden victory, I think it's fair to say the markets would take a bit of a breather, perhaps a little bit of profit taking. I don't think we would expect sort of an Armageddon style market reaction to a Biden victory, but I do think it's fair to say that there could be a bit of a pause, a bit of a breather in market performance. Trump has historically been very business friendly, so regardless of personal opinions of him, for performance of the market, it actually could be rather supportive for share prices if we saw a sort of a Trump victory. I think the other really important thing to remember, though, as well, is regardless of the presidential outcome, much of the driver that we've sort of seen from US share prices up to this point has sort of been thematically driven. So obviously the US is home to a lot of technology and healthcare companies, and fundamentally those are themes that we see playing out over many years. So the impact of a presidential on those sort of themes longer term, in our opinion, will be limited. So yes, we are conscious of where that will go, where the election and what outcome we will see from the US election, but it wouldn't fundamentally change our positioning in our portfolios. We certainly wouldn't want to position the portfolios to take a bet on who may or may not win. That's certainly not what we do. It's more about underlying trends and, as I say, thematically where we want to be invested. And absolutely for your clients should perhaps focus on that. Yes, of course, pay attention to the election and the outcome and the implications, but also don't forget fundamentally underneath there's those trends that are ongoing that we look to profit and benefit from.
Yeah, because I found it quite interesting. I read an article, I think last week, where they were saying that actually the relationship with China, and let's face it, that the East is still probably the growth area for the next couple of decades in terms of volume of population, technology, and just potential markets. It was interesting to note that they were saying that Biden's view is fairly similar actually to Trump's, and they've gone down so far in the discussions with China that Biden would be very, very weak, and it would have a real impact on America if he suddenly backtracked. So I take it you've almost got to, like I say, almost the election result is almost so what?
Yeah, completely. And also another theme that we've heard a lot from our emerging market equity active fund managers when we've had meetings with them is what's being branded as re-globalization. So I think COVID has taught companies not to really rely on just one country or one area in your sort of supply chain. It's much more sensible to diversify your supply chain across various different countries. So you're right in your comment about the East, but actually we could allocate to different regions in emerging markets that firstly would be less impacted by the sort of US-China trade war, and sort of secondly are becoming increasingly popular with, as I say, these businesses which are sourcing a new supply chain or a more diverse supply chain. So again, that's a really interesting theme as well. So perhaps the reliance on China will become less, so therefore the impact on investment returns because of the US-China trade war may also become slightly less as well because of that re-globalization theme that seems to be coming through.
Okay, so I suppose then the biggest risk to the economy, if we can sort of put the presidential election in the US to one side and say no matter what, actually businesses are now looking further afield, like I say, they're diversifying, they're lowering their own risk in terms of production.
Yeah.
The biggest risk, we're seeing it in Europe at the moment, and certainly I think South Korea, etc., is we're seeing the number of cases of COVID starting to increase again, particularly amongst the younger generation, which raises that fear we've always had. Will we go into lockdown during the winter? So can the markets cope with that, and how are you planning for that again within the investment sphere?
Yeah, that's a really good question. So we're already starting to see sort of signs of government reactions to the thought of another sort of nationwide lockdown. And what we've seen so far is a reluctance, understandably, amongst various governments to lock down entire nations again, entire countries again. Often the preferred option is more localized lockdowns, which of course makes more sense economically, and also giving back that power to more local authorities to control the lockdown and the sort of trying to get those virus numbers back under control again. So we're seeing that, and that's very supportive for markets. Markets like that. So obviously we don't want to see, nobody really wants to see entire countries locked down again. The other thing we're seeing as well is that sort of language that comes out of particularly central bank meetings or from governmental leaders about that willingness to sort of kickstart more supportive programs again for the various economies. And again, the market really likes that. And I think it's also fair to say that the support packages that were put in place initially and still are being relied on today broadly have been very successful in damage limitation to economies. Broadly speaking, across the world, it's actually worked quite well what governments have done, particularly the speed in how they've acted as well. So that's really, really important to remember. So if you want to call that a first draft or a dry run of a reaction, then that practice run, if you want to call it that, by and large went very well. So the market now has this level of confidence in various countries' abilities to support the economy should we go back into lockdown. So to come around to your question again, could we cope with another lockdown? I don't think, mentally and emotionally, that's a different question. But in terms of economically, I would probably say yes. And I don't think we would see the level of drawdown that we saw initially in markets. I don't think, obviously, they wouldn't like it, but we've kind of had proof that the policies have worked, and we could do a repeat of that again, if that makes sense.
It does, yeah. It ties in again with bits and pieces I'm reading. People are saying, well, actually, we've learnt now, we're coping with it, and actually the virus does seem to have moved on from the problems we had at the start to, it seems to be very much a younger generation, the under 30s driven infection rate, which is why we're not seeing the same level of hospitalisation and the same death rates coming forward. We talked about government debt there and the government borrowing and what's gone through. We talked earlier about possible tax rises in November. I suppose also from my experience, I was advising through the tech boom in 99-2000 when we saw tech shares rising phenomenally. I think it was it the Aberdeen fund that did about 800% return and then crashed to absolutely zero very, very quickly. I suppose my question is, are we in a different environment that we're not going to see a tech bubble come to a similar conclusion? And how much more debt can governments actually take on? Are we talking the same level as World War II, when I think it was 2 or 3 times the GDP of the country, but the borrowing kept going because it was a fight, it was clear, it had to be done? Are we in the same situation, or are we on a precipice where actually some assets could lose substantial value because the market suddenly changed their view?
Yeah, I mean, looking at the tech one's a really interesting point, isn't it? Because I mean, some of the companies in that space have performed exceptionally well, and we've more than doubled our money in a lot of the holdings in that space in the clients' portfolios. So yes, we have been managing that exposure there, and I think it's fair to say that certain companies in the tech space, you could argue valuations are a little bit stretched there.
But I was about to say, I mean, if I can just mention, I know on the questions, big surprise, I let Alex know roughly what I'm going to ask him as we go along, otherwise it's a bit unfair. But I mentioned Tesla. I keep looking at it, how on earth is that worth what it's worth when the product is quite poor, it sells very low, and they've got a little bit of a loose cannon at the head of the business?
He's a very interesting head of the company, but yeah, exactly right. So you look at some of these prices and you do think, wow, the performance, and this year alone, and especially with what's been going on and where the valuations are now, you can question certain companies' current valuations may be a little bit stretched, which is exactly why we really like active managers in the tech space. because they can actually manage exposure and trim positions which perhaps have got a little bit too far ahead of themselves and reallocate into other interesting names. So I would stress that technology as a theme, I would not say as a bubble like it was back in the 90s, because basically anything back then, anything which was vaguely to do with technology, even if it was a brand new business and, you know, was not even profitable, you know, the shares were going up tenfold. It is a different kind of scenario now. You know, these are genuine businesses providing genuine services that the consumer in 2020 really wants. So thematically, that exposure, or that kind of area, I would not say is in a bubble. It's easy to focus on a few names, and yeah, you can say, look, for example, could Netflix, can they really continue to add to their subscriber base at the rate they're doing so, particularly if lockdown measures are eased? And, you know, you can argue stock-specific examples, certainly, but as I stress, that's why an active manager in the tech space is absolutely vital. And, you know, you can get and we do have some fantastic funds there, which will manage those risks. So, but yeah, if you look at kind of things like data connectivity, software as a service, e-commerce, these kind of broader trends, you know, that's absolutely fundamental. That's a sort of pillar of a sort of modern economy. So yeah, I wouldn't say that's getting too carried away. And again, we're very, very keen to be invested in those areas. And then looking at your government debt point, I mean, how much more debt can the governments get into? It's already absolutely astronomical. And we've seen recently bond prices selling off. Again, that's mainly because investors are basically thinking, hold on, I'm not getting much return from my debt here. You know, the returns aren't very exciting. They're rather boring. And they're thinking, actually, maybe I can get a more attractive return in my equity space. So that's why we're seeing some money coming out of those fixed income markets back into equities. But the next sign of market instability and economic worry, you would expect to see a reversal back into government debt, and corporate debt. So that's why it still forms a part of our portfolios. But I would stress that we are underweight bonds and fixed income generally. So we are a bit underweight there. The other thing, of course, to bear in mind is just how low interest rates are. So it is so unbelievably cheap to borrow money now, and that goes for personal and governments look at it in exactly the same way. You know, they can borrow money at incredibly low levels, so it's actually quite affordable for them to service that debt. That's the risk, isn't it? It's how affordable is it for the governments, and you know, you can look at it from a personal point of view as well. How affordable is it to service that debt? And there's the risk. So near term, we don't expect, you know, interest rates to materially increase, you know, given that level of debt. So long as the sort of status quo is maintained, governments can maintain their debt repayments. You know, I can see, you know, more debt being issued by governments. And, you know, as I say, if that's still affordable and easily maintained, we shouldn't see too much of an issue of that. But of course, the risk then comes on if that debt does not become manageable.
So I suppose it's different in that way from the late noughties when we were bailing out the banks, because at that point it was more expensive.
Absolutely.
So look at the repayments rather than the level of the debt, because if you look at the level of debt, to me it's just unimaginable. However, the repayment of it is actually relatively small compared to where we were just a decade ago.
Yeah, exactly right. So it's a very different scenario that we're in now than we were 10 years ago, 12 years ago. So but it is quite, don't get me wrong, it's very shocking when you see the levels of debt that governments across the world and countries are in. But equally, you can balance that out with actually it's much more affordable now to service that debt. So it's a tough one to get your head around initially, but you know, as I say, if the status quo is kind of maintained, then I can see more debt being issued.
Okay, well, that's good. I think, as usual, for me, what's come out of this is actually there's still opportunities out there. There's still investment opportunities. There's still growth. The fact that the main market indices are staying relatively level is, again, just that normal movement of people like EasyJet falling out, other companies coming in. So really, as usual, it's down to diversification, understand your risk in the investment and make sure it fits within where you are, and sit tight, because we've got furlough coming to an end in the next couple of months. We'll see how that impacts. More companies, I think, was it Capita, said that they're going to not insist people go back to an office. They're going to do more home working. that should, on the same wages, give more people more money in their back pocket and businesses more profit. If they're cutting back on staff, will find they don't need the same number of staff. So actually, we're still in that quite interesting, and if you're a bit like us, you're interested in this area, quite exciting area. Where is the economy going? Where are the investment opportunities? And what's the next big thing that we need to be looking out for?
Yeah, yeah, massively. So as you say, all this shift in behaviour from corporates down to how people live their lives on a day-to-day basis does absolutely create really interesting investment opportunities. So, you know, near term, it isn't going to be, you know, pretty reading. You know, we haven't seen the full effect of the unemployment figures coming out of all this. And like you quite rightly say, you know, the end of the furlough scheme coming into sort of next year as well, we'll kind of get a clearer picture of where unemployment truly will sit. As a result of this, and it will be substantially higher, in my opinion, than where it is right now. But again, we are expecting that. We are expecting that. So it's obviously terrible for the people involved. But looking at the investment portfolios and the markets, there is that expectation. Yes, if it surprises on the upside, then you know expect some near-term volatility. But again, that's a great trading opportunity for us to maybe move into areas that, as we were talking about before, you know, you might have thought, oh, they're a little bit expensive, they've got a bit carried away with themselves. Well, when you get those market adjustments downwards, that's a good time for active managers like us to deploy capital into those interesting areas that you've been watching on the sideline. So yeah, absolutely. You know, for the clients to just not get too drawn into the doom and gloom negative headlines that sells the papers, because that's not what drives returns. And I heard a good analogy, you know, it's used quite a lot in our industry, but it's kind of like if you drive your car only looking in the rear view mirror, it's not going to be long before you have a pretty nasty accident. And basically that's just stressing the importance of not to you look backwards and always obsess with what has happened. It's actually, where are we going and what can you see evolving over the next sort of 5 to 10 years, and how can you capture those shifts, which is
absolutely
important.
I think it's fair to say the world's changing, and COVID and everything has just speeded that up. So there are opportunities there. It's just always that pain before you get to the other side, and you see what's awaiting us.
Yeah, absolutely. So, and it's down on people like us to try and protect the money from the volatility as best we can, but equally making sure that we do capture some of those interesting trends and themes that you spoke about as well in the portfolio. So the longer term is obviously you capture that growth.
Absolutely. Alex, I believe we're due to talk again in early December, so expect, I'm sorry, Christmas tinsel and a few Santa hats on that video probably.
I'll see what I can dig out of the wardrobe on that front. Yeah.
Okay, that's probably an area that it's fair to say we'll call an end to today. But Alex, thank you very much again for your time, much appreciated, and thank you for shedding some light on what is at the moment just an uncertain time.
Yeah, thanks a lot, Tom. Cheers.
All right, well, thank you very much to everyone for taking time to watch the video. Any questions, contact details at the end. We're more than happy to help. But for now, thanks very much and bye-bye.